Understanding fair value gaps, FVG in trading. Fair value gaps are market inefficiencies caused by rapid price movements, leaving areas untraded. This guide will help you identify, interpret, and implement FVG strategies for successful trading. Identifying fair value gaps on charts. Key characteristics in the FVG: 3 candlesticks where the high of the first and low of the third do not overlap. Bullish FVG: first candle's high is lower than the third candle's low. Price may revisit for support. Bearish FVG: first candle's low is higher than the third candle's high. Price may revisit for resistance. Trading strategies. Using FVGs. Bullish FVG. Entry: look for a retracement of price into the FVG after an initial upward movement, waiting for a confirmation candle. Bullish engulfing hammer within the FVG. Bearish FVG entry: look for a retracement of price into the FVG after an initial downward movement, waiting for a confirmation candle. Bearish engulfing shooting star within the FVG. Limit orders. Placing limit orders at the edge of the FVG for potential entries offers precise entry and better risk reward. Setting stop loss and take profit levels. Stop loss placement. For bullish FVGs, place stop loss orders just below the low of the FVG. For bearish FVGs, place stop loss orders just above the high of the FVG. Take profit levels. Use resistance levels, previous highs or Fibonacci extensions to determine take profit levels for bullish FVGs, and support levels, previous lows or Fibonacci extensions for bearish FVGs. Risk-reward ratio. Aim for a minimum of 1:2 or 1:3 risk-reward ratio, ensuring that potential gains significantly exceed potential losses in each trade. Confluence factors for higher probability trades. Support, resistance. FVGs aligning with key support or resistance areas. Established trends, FVGs appearing within an established trend. Fibonacci levels, FVGs coinciding with Fibonacci retracement levels, e.g. 61.8%. Moving averages, price crossing a moving average within an FVG. Risk management strategies for FVG trading. Position sizing. Risk only a small percentage of your trading capital per trade, e.g. 1 to 2%. Diversification. Avoid relying solely on FVG trading by combining it with other strategies. Trading psychology. Stay disciplined by avoiding emotional decisions and sticking to your trading plan. Real-world examples of FVG trading. Case study. 1. EUR/USD daily chart. An example of identifying an FVG on a EUR/USD daily chart, including entry trigger, stop loss, and take profit levels, and the trade's outcome. Case study 2. GBP/JPY H4 chart. An example of identifying an FVG on a GBP/JPY H4 chart, including entry trigger, stop loss, and take profit levels, and the trade's outcome. Backtesting results illustrates the historical performance of the FVG trading strategy, highlighting the win rate, average profit, average loss, and overall profitability. Conclusion: mastering the FVG trading strategy. Clearly defined entry and exit points. High probability setups when combined with confluence factors. Relatively simple to learn and implement. Limitations and continuous learning. FVGs can fail to hold. Market conditions can change rapidly, requires patience and discipline. Next steps: refining your FVG strategy. Stay updated on market dynamics and refine your FVG trading strategy. Practice on demo accounts before trading with real money.